Life insurance, the greatest financial miracle. What is the literal meaning of insurance? Everything in our lives, including our investments, come with two things: risks and rewards. So, when there is a risk, there can be returns, but there can be losses too. That means investments with the potential to reward the most also usually have the potential to risk the most. There are things we can do with the risk. There are good risks, we can keep the risk. If there is a gain or returns or good risk, we can very well cope with it and we celebrate. And there are bad risks. When there is a bad risk, it could destroy everything we have or we have created. These are the risks that should be transferred. Are we risk seekers or risk avoiders or risk averse? Risk seeking is one's acceptance of greater risk or one's rejection of certainty in favor of a gamble or uncertainty in exchange for the potential for higher returns. Whereas risk aversion refers to the tendency of an economic agent to strictly prefer certainty over uncertainty. The heart of insurance that enables insurance to function is risk aversion. Insurance is a means of protecting ourselves from the unforeseen, unavoidable risks of life. It is simply about protecting what we value and care about most by passing the bad risks of financial loss to an insurance company which compensates us for the losses. As quoted by Tony Gordon, life insurance is just a risk management. We transfer the risks from families who cannot afford it to insurance companies who can. That's all it is. This is insurance. Life insurance transactions occur because we prefer to be risk averse than risk seeking, to prefer outcomes which are more predictable compared to those outcomes which are less predictable. Risk averse people live by the phrase, a bird in the hand is worth two in the bush. Having something certain is better than taking a risk for more or for something better, because if you take a chance, you might lose everything. Why get life insurance in the first place? As far as life insurance is concerned, think about it in terms of three L's. Love, protect their loved ones. If people are depending on them financially, then life insurance is a must. It can help make sure that their partner and children can cover their daily expenses like food, bills, education, and housing. Loans. They can apply for hassle-free loans without putting any physical asset as collateral. They can pay off debts. In addition to loved ones experiencing emotional loss, they don't want them to experience financial loss and the instability and the stress that follows. And legacy planning. Life insurance provides financial security to help loved ones save for college, plan for retirement, or achieve other financial goals. They can also use life insurance to leave an inheritance for loved ones or support a cause that matters to them, like leaving money to a favorite charity or organization tax free, and it will not be included in their taxable estate. It is a sound risk management decision which protects an individual against risks of life. Mortality, that is, protect against death or disability. Second, morbidity, that is, protect against disease. Third, longevity, that is, living longer and beyond our income generating capacity. Fourth, market volatility, that is, guaranteed returns. Fifth, financial indiscipline, protecting the money from consumerism and lack of discipline. Additionally, it offers convenience and the capability to structure products that last for a lifetime. Insurance is the best product to manage for long-term uncertainties. It is the only financial product that offers long-term guaranteed returns with no call option. The challenge of managing market and interest rate volatility for the future is a skill set possessed only by life insurers. Misconceptions surrounding life insurance products discourage us from considering them as vital instruments of financial planning. Do we ever worry if we'll be okay in our old age, in our retirement, or if our family will be okay financially when we are gone? We can see from the image that the gap sorry, between needs and accumulated funds can only be filled through insurance. One can be single, working, with no cares in the world, or be married with kids, or children's education and marriage, or retirement and medical needs in old age can only be filled through insurance. We are probably thinking this costs a lot of money. It does cost a lot of money if we use the wrong products and leave these decisions until it is too late. The earlier we start, the better it is, since life insurance premiums are lower at an earlier age and begin to rise as we age. As quoted by Kin Hubbard, fun is like life insurance. The older you get, the more it costs. Life insurance has long been a cornerstone of financial security. It has always stood the test of time, always doing as promised to us and our family. It can also act as a source of earning for a few decades of our retirement or if accidents or ailments affect our income. It provides peace of mind that our family and dependents will be looked after financially should the worst happen. Taking some time to understand more about life insurance is worth its weight in gold, as it could protect the financial stability of those we care for if we are no longer working or we pass away. The trampoline of life. As quoted by Ben Feldman, every man has problems that only life insurance can solve. In the young man's case, the problem is to create cash. For the old man is to conserve it. Life insurance can't prevent the first tragedy, but it can help prevent the second one, the financial impact of an unexpected life event. This trampoline of life protects us no matter how high we want to jump in life. Life insurance and longevity. Report of the Expert Committee on Longevity Finance published on 12th April 2022 by International Financial Services Centers Authority, a statutory authority established by Government of India. The report analyzes the concept of longevity, India's opportunities and challenges. Section 6, Insurance, Reinsurance, Pension Fund and Medical Tourism. Section 6.1, Insurance, page 60, which states that life insurers are uniquely poised to be the only players in the market to cover both the critical risks, the risk of dying too early and the risk of living too long. Protection products, both life and health, provide safety to the policyholders and their families against the risk of death, disease, and disability. Annuity products, on the other hand, ensure a regular inflow of income until the annuitant's death, thereby mitigating longevity risk, that is, the risk of outliving one's savings. If we are not risk averse with our life and don't anticipate financial risks and do something about it now, it is going to cause imminent poverty in retirement. Will you run out of money before you run out of life? Planning and strategy for a Sound Financial Future by Michael Namesick. The book is available on Amazon.com. And as quoted by Burton G. Malkiel, the risk in old age is not premature death. The risk is that you will live too long and outlive your assets. And we will be forced to work till our bodies allow us to. It's about that new reality of wanting a safety net for our loved ones. The life event of getting married or having a child is usually what motivates us to purchase life insurance. Like any new parent, we want to do everything we can to protect our family's future. The vision we have for our family, we secure it with a policy that factors in caregiving, our plans for education and marriage of our kids in the future or our own retirement. With life insurance, the designated beneficiary or beneficiaries may use the policy's both living as well as death benefit to help with deaths, living expenses, or future plans. It boils down to the idea of wanting to deliver on what we hope for our family, whether we are around to see it or not. As quoted by Gary Cohn, if you don't invest in risk management, it doesn't matter what business you are in, it is a risky business. And as quoted by Ben Feldman, life insurance is time. The time a man might not have. If he needs time, he needs life insurance. And as quoted by Tennessee Williams, you can be young without money, but you can't be old without it. Always remember, it's our life. We are the master of our destiny. Returns are the rewards for the risks we take. And to protect us and our family from those risks, there's life insurance. Life insurance is an effective risk transfer tool which is in existence since 1583, almost half a millennium. Life insurance is the most misunderstood financial instrument. Life insurance is much more than just death benefit. Come pandemic, war, natural disaster, recession, sequence of returns risk, or death, that is both living and death benefits, life insurance is the only financial instrument that stands tall, which has been proven on numerous occasions. Insurance can have various effects on society. It can help societies and individuals prepare for any crisis and reduce the effects of those crises on both households and societies. As quoted by Benjamin Franklin, the father of American insurance, a policy of life insurance is the cheapest and the safest mode of making a certain provision for one's family. The insurance plan provides financial support with sufficient coverage that will be useful when the appropriate time comes. That is, when we need it most. One day we will thank ourselves. May the force of greatest financial miracle be with you. Please go through the description for the sources for this presentation. I've shared the link to my next presentation, Harnessing the Benefits of Tax Deferred Compound Interest in Life Insurance, at the end of this presentation. And do not forget to check out the playlists for more presentations. If there is something to gain and nothing to lose by asking, by all means ask. Thank you for taking the time to watch this presentation. I sincerely appreciate it. Namaste.